accounting for insurance company, IAS 14. And insurance company, they are just the entity or the companies offering or which covers risk on the behalf of the client who may suffer loss or who may insure against the loss. And for the insurance company, they usually do cover that risk at a consideration known as the premium. So that means for the insurance company, their major or the operating income, their major operating income is the premiums. Also, the major operating expense or the major expense is the premium, I mean the claims paid. Another thing you need to note that for the insurance compensation, we have said that their major source of income is the premium, or they charge their client the premium as a consideration. Now that consideration of the premium corrected is also now utilized for the payment of the for compensation in case the client suffers a loss. And the amount that you pay is what we call the claims. So that's all about the insurance company. Then the insurance company, they are classified into two. We have what we call the general insurance and we have the life assurance. So there are two. And how we account for the two, they are totally different. Now for the general insurance, they usually do cover against loss of property. That's the the general insurance. Then we have life assurance. For the life assurance, they cover against the loss of life. So that means you're insuring against death, but for the other one is against the loss of property. And then we'll come to see some of terminology which are used when accounting for insurance. Some terminology such as commission ceded will come through, commission ceded, commission accepted. We have what we call reserve for an earned premium, etc. So now let's go to the whiteboard so that we can write something. Yeah, we are looking for accounting for insurance company, and that's IAS 14. And we have said that there are entities which covers risk for the client for a consideration known as the premiums. Then we have said that their main source of income or their major source of income are the premiums. And their major expense is the claims. And these claims are paid in terms of compensation. In terms of compensation. So you need to note that their major source of income, their major expense, those are what we call the operating cash flows. Then we have said that we have two types of insurance. Type of insurance business. Number one, we have what we call the general insurance. And number two, we have the life. We have the life assurance. The difference between the two is that for the general insurance, it covers against the loss of property. Loss of property. But for the life assurance, it covers against the loss of life. Loss of life. Good. Then for the life insurance, they are further classified into two, where we have what we call the whole life policy. You can take the whole life policy, or you can have what we call the endowment policy. Those are the two types of policy under the life assurance. Now, for the whole life policy, or for the whole life policy, this is where the amount or the compensation will be paid upon the death of the policy holder. So here you say that the compensation is received upon the death. What does that mean? That means the policy holder will not be the beneficiary. The beneficiary for the whole life will be the next of kin. But for endowment policy, this one, you have a contract. And for this contract, it has a specific maturity period. What does that mean? For endowment policy, you may sign a contract. That means if I don't die for the next 10 years, you pay me. back my compensation. So that means for endowment policy, the amount payable or the sum insured will be payable on the area of either the death or a specific date which is considered as maturity period. So we are saying that the sum of insured will be payable. So here is payable upon the area of either death or what is considered as the maturity period. Maturity period. So for endowment policy has a specific period that we can say between 5 years, we can say 10 years, 15 years, or 20 years. So for endowment policy, the policyholder can also be the beneficiary. And also the next of kin can also be the beneficiary. But you have said that for the whole life policy, only the next of kin will be beneficiary, because this one you only get the compensation upon the death of the policy holder. So that's the difference between the general insurance and the life assurance. Good. So now let's look at other terminology applied. So I'm just hoping you are not copying. Kindly don't copy. We'll share the handout of what we learned today later. So we look at some terminologies which will be used when accounting for the insurance. One, we have what we call commission ceded. Number two, we have the commission accepted. First of all, let's differentiate the two. Now, for the commission ceded, is just an income which is based on the percentage of the proportion of reinsurance premium paid. So is an income determined as a percentage or proportion of reinsurance premium paid, reinsurance premium paid. So in short, it's just the commission earned from other insurance company. So this one is a commission earned from other insurance company. Then we have the commission accepted. It's an expense. This one is an expense determined as a proportion of reinsurance premium received. Yeah. In other elements language is that it's an expense incurred as a result of other insurance company transferring the risk to other insurance company. So for the commission ceded, it's an income, but for the commission accepted, it's an expense. So you need to note that. Then we have talked about proportion of reinsurance premium. What is reinsurance? Now, reinsurance, this is where an insurance company insures itself against loss in another insurance company. Or it's where one insurance company takes a cover in another insurance company. Or we can say that is a transfer of risk. Transfer of risk from one insurance company to another. Yeah, and we have said that's why one insurance company takes insurance cover in another insurance company. For example, we may have the CIC taking an insurance cover in Jubilee insurance. Or it can be the vice versa, where the Jubilee Insurance takes cover in CIC. Now that's what we call the reinsurance. Good. Another terminology we come through, it's what we call reserve for an expired risk. Expired risk, also known as reserves for an earned, reserve for an earned premium. And what's this? If you see it's a reserve, that's money set aside, or the amount set aside to cater for the payment of claims in the future. So you're saying that is the amount of premium set aside to cater for the payment, to cater for the future payment of the claims. Yeah, it's known as the reserve for an expired risk or reserve for an earned premium. The two terminology will be used interchangeably. So if you find an expired risk or for an earned premium, know that they are meaning the same, and reserve. And where do we take reserve? Reserve, they are part of none. I mean, part of equity. Reserve, their part forms the part of equity. So that's the reserve for an expired risk. Then another terminology may come through is what we call the indemnity clause. So that one you read it from the handout. I have already indicated them in the handout I'll send through. Also, we may have the annuity. Also the bonus. Yeah, those are the terminology used for the insurance. And for indemnity, if I just explain, I will not write it. It's just a contractual transfer of risk between two contractual parties, generally to prevent the loss or the compensation for a loss, which may occur as a result of specific events. That's the indemnity clause. It's just a contractual obligation. Then for the annuity, is the amount payable to the policyholder, usually in equal installment. That's what we call an annuity. Now, for example, assuming they are paying you your claims, or for example, like 10 million, they can assume that this 10 million, they pay you in bits of 2 million, 2 million, 2 million, 2 million, until it reaches 10. Now, that's what we call the annuity. I say that is the amount payable to the policyholder, usually in equal installment. Good. Then we have the bonus. Now, the bonus, for example, if you take, for example, you take education policy, education insurance policy, and you contribute like 2 million. Now, upon the maturity of the policy, you will not get 2 million. You will get 2 plus something. You see what the insurance usually does? The amount you have been contributing, they also invest. After they invest, the return they get or the profit, remember they invested using your money. So you're entitled to get a share of that profit or the return they'll get. So now what you'll get that extra, for example, assuming you get 2.4. Now this 400,000 is what is considered as the bonus. And simply is just an amount payable to the life policy holder as part of the profit generated by the company. Good. So for those doing a screenshot, you can now do the screenshot. And kindly, I want you this definition to be at your fingertips. The first two actually. Commission ceded due an income, and how do we determine that income? Is the income determined as the proportion of reinsurance premium paid? Ni muhimu sana. Yeah, reinsurance premium paid. But commission accepted is an expense determined as a proportion of reinsurance premium received. Good. So now we can go to another part. Now this, how do we account for the insurance company? Now, for the insurance company, I usually do prepare what we call the revenue account. And the revenue account they prepare for them to determine either they operated at a profit or they operated at a loss. So the motive of the, preparing the revenue account is to determine whether they're operating at a profit or they're operating at a loss. And how do we prepare the revenue account? And this is how we prepare the revenue account. This is the format for revenue account. Revenue account. Allow me to use this one. Yeah, it has the debit side and it has the credit side. So for the credit side, we bring the incomes. For the debit side, we'll be recording the expenses. For example, we have said that their major source of income is the premiums. And this is how we get the net premium. So you start with the premium received, then you add premium receivable, balance carried down, premium balance carried down. That's the premium you have not yet received, but you are supposed to receive by the end of the rest of the year. Then you raise the premium at the beginning, or the premium balance brought down. Then also you add reinsurance premium received, reinsurance premium received, you add it, but you deduct the reinsurance premium paid. Your tulilipa, that one becomes an outflow. And that's how you get the net premium. Now, let's go to the debit side. We say that their major source of expense is the claims. How do we determine the claims? For the claims, you start with the claims paid. You add claims balance carried down. That's at the end of the year. Then you deduct claims balance brought down. You deduct that. Then you can also deduct the claims covered on reinsurance. Claims covered on reinsurance. Yeah, this is the claims. The other insurance company walikusaidia kulipa, so deduct that one. And then you can also add, the claim expenses. Claim expenses, maybe such as survey expenses or the legal expenses relating directly to the claims. Now what you get there is the net claims. Now after that, let's go back to the credit side. The revenue account is not yet through. So utaanza hapa net premium, and then you add other incomes, and then you bring reserve for an expired or for an earned premium. An earned premium balance brought down. Unaiweka hapo. And then on the other side, you bring the reserves for an earned premium, for an earned premium balance carried down. Brought down, carried down. And then another income you need to bring here is the commission ceded. Remember, I said that commission ceded, it's an income. Then on the other side, you have the net claims. Then you had another income, another expense, commission accepted. We say that commission accepted, it's an expense. Unaiweka hapo. Then you bring other expenses such as management expenses. You may have the legal expenses. You may have the bad debt, etc. And then you balance. Now, when balancing, if the credit side or the incomes are more than the expenses, you record a profit or the gain. But when the expenses are more than the incomes, you record a loss. And when balancing, you'll be counting from, you'll be considering from this place for the net premium going downwards and from the net claims going downwards. So that's the format for the revenue account. You can screenshot that for those without the notes. I have not said you copy, just screenshot that so that we can try an illustration. Good. Now let's do this question. May 2017, question 5B. May 2017, question 5B. Just hoping we are there now. We're doing part 5, question 5B. Question 5B, you are told that the following trial balance was extracted from the book of Maripo Insurance Company Limited, which specializes in general insurance as at that 1st March 2017. So you have the freehold property, motor vehicles, machinery and equipment, furnitures, audit fee paid, director's fee, depreciation on current assets. We have the management expenses for both the marine and the fire, account receivable and account payable, investment income. Now, before we proceed, here we have audit fee paid, director's fee. You see the expenses. Also, we have the management expenses. We say that for the revenue account, for this revenue account, you bring the expenses on the debit side, but only you bring the expenses which are specific. The expenses which are specific, you bring them to the revenue account. For those which are general, you take them to the general income statement. What do I mean? This is what I mean. For example, You see, for the director's fee, they have not specified. Is it for the marine? Is it for the fire? So that one you take to the general income statement. But for the management expenses, they have specified. So that one will go to the revenue account. Account receivable and account payable, investment income, ordinary share capital, share premium, retained profit, premium outstanding as at 1st April 2016. Those are the premium balance brought down. Unearned premium. Then we have claims outstanding as at 1st April 2016. That's the opening still. Then we have the claims paid. Then we have the legal cost, expenses relating to claims, bad debt written off. We have investment in shares. Also, you have the direct premium received, reinsurance premium received, reinsurance premium paid, bank balance, and cash in hand. Additional information. Number one, an unearned premium reserve for an expired risk is to be maintained as 100% and 50% for the premiums of the premium for marine insurance and fire insurance, respectively. Number two, commission on both insurance ceded and reinsurance accepted is at the rate of 5% of the premiums. Number three, directors have proposed a dividend of 5% on the outstanding share capital as at 31st March 2017. The tax rate applicable is 30%. Premiums outstanding as at that 1st March 2017 amounted to 1,800 million and 840 million for marine insurance and fire insurance, respectively. Number six, claims intimated and outstanding as at that 1st March 2017 amounted to 900 million for marine insurance and 576 million for fire insurance. Required revenue account for both marine insurance and fire insurance for the year ended that 1st March 2017. Number two, statement of comprehensive income for the year ended that 1st March 2017, and the statement of financial position as at that 1st March 2017. Now, in an exam case, in case you forget about the revenue account, you can start with number two and number three. Like for example, for the statement of comprehensive income, it has 3 marks. That means you just require 3 correct entries. Na hiyo ni kuangalia tu, hiyo ni kazi ya macho. For example, in this case, we have audit fee paid. Hiyo ni expense moja, director's fee, another expense, depreciation on current asset, another expense. Hizo ni 3. And then you already have investment income. Hiyo ni income. Hizo ni 4. So you are through with the income statement and you get your 3 marks. Then for the statement of financial position, 6 marks. Everyone knows what to take to the balance sheet. To the balance sheet, you just require to know the assets and liability and the equity. Now, for the assets, you see at 6 marks. So that means you just require 6 correct entries. We have the freehold property, that 1 marks. Motor vehicle, another mark. Machinery, another mark. Furnitures, is only 4 marks. Then we also have account receivable and account payable. Is on marks bearing. 1 for the current asset, the other one for the current liability. Then kwa equity we have the ordinary share capital and the share premium. Na hiyo imeisha hivyo. So in an exam you just need to work smart. But number 1, where you have the 5 marks for the revenue account. For the revenue account, you need to have the format at your fingertips. Na si lazima ujue kila kitu. For the 5 marks, you just require now for the revenue, I'll show you how to award the marks. How you get the 5 marks. For the revenue account, you don't require 5. You require 10 correct entries. So let's start with that. For the revenue account, just allow me to write the format. I had already given you the format. Based on the information given, unakuja tu hapa. We said on this side, we start with the incomes here, and we start with the premium received. Then you bring premiums balance carried down, but you raise or you deduct premiums balance brought down. That's what we said. Then you said you add reinsurance premium received, reinsurance premium received, you add that, but you raise reinsurance premium paid. That's what we said. Then you can get the net premiums. On the other side, on the debit side, now we focus on the expenses. And their major expense was the claims. So tutaanza na claims paid. Then we add claims balance carried down. Then we raise claims balance brought down. And also we say that we also raise, we also deduct claims covered on reinsurance. But in this question, we didn't add that. And then we said also we add claim expenses. So I have seen we had claim expenses. So you also add claim expenses. Now that's how you get the net claims. Was that to deal up to that point? So it wasn't a premium received. So we have direct premium received, tumepewa hapo. For marine, it's 5,400, and for fire, it's 4,200. So that one will be 5,400. The other one was 4,200. We just recorded them there. Then you add premium balance carried down. Or first of all, let's just fill with what we have. So we have reinsurance premium received. So hiyo tunaweka. And for the reinsurance premium received, tulisema you add reinsurance premium received. This one's 14. Yeah, this one is 1440. The other one is 960. Then reinsurance premium paid. Tuko nayo hapo. Reinsurance premium paid. Hiyo tunatoa 960 and 600. So 960, you deduct that. And also we had the 600. Then on the other side, we had claims paid. You see, we have the claims paid here. For the marine, ndio hiyo, and for the fire is that. So claims paid here we have 2964. For the fire is 2160. Then also we have the expenses relating to claim marine 384. Now we also said we add the claim expenses we add. So that one we are given the claims relating to marine, to claims. Yeah, expenses relating to claim on the marine side. So unakuja hapa kwa marine, it was 384. You add it. Then we have this premium outstanding as at 1st April 2016. Now that's what we call the premium balance brought down. Na tukasema for brought down, you minus. We say that you raise premium balance brought down, but we add premium balance carried down. So in this case, we are given the premium outstanding. That's the balance brought down. 1st April 2016. So you come here to the format. Premiums balance brought down 1080, you minus that 840. Then you also have claims outstanding. Claims outstanding on 1st April 2016 for marine and fire 960 and 648. So you add or you deduct claims balance brought down 960, and we have 648. Let's go to the additional information. Note number 4, note number 5. Number 5, you are told that premiums outstanding as at that 1st March 2017 amounted to 1,800 million and 840 million for marine insurance and fire insurance, respectively. Now, those are the premium balance carried down. For our format, we say that we add premium balance carried down. We have given 1,800 and 840. Then note number 6. Note number 6. Note number 6. Claims intimated and outstanding as at that 1st March 2017 amounted to 900 million for marine insurance and 576 million for fire insurance. Those are the claims balance carried down. So unaileta hapa. For the claims balance carried down, we are given 900 for marine and 576 for fire insurance. So for that now we can get the net claims and the net premium. So you see the claims outstanding on 1st, it was 648, not 618. There is someone saying that claims outstanding balance go down should be 618. Unaona hapa iko clear, yeah? It's 648. It's not 618. Good. So now let's get the net claims or the net. So this one, you'll get that 288, and this one you'll get 2088. And here we have 66. And here we have 4560. Then, as we continue, after you get the net premium, if I take you back to the format, after now you have the net premium, you bring other income. And on the other side, after you have the net claims, you bring other expenses. So, utakuja hapa. After the net premium, we said you also add the unearned premium reserve balance brought down. So, an unearned reserve, premium reserve balance brought down. Then you bring another income, which was commission ceded. Commission ceded. Then on the other side, we bring other expenses. For the expenses, we had management expenses. Also, we have the commission accepted. Commission accepted. Also, you can see we had the bad debt. Also, we had the legal expenses. And then here we have the unearned reserve balance brought down. Here you bring the reserves balance carried down. So you're given here an earned premium as at 1st April 2016. Those are the premium reserve balance brought down for the marine and for the fire. We have 5760 and 3000. So that one una report hapa kwa an earned reserve balance brought down. We have 5760 and 3000. Then we also have management expenses. For the management expense, we have both for marine and fire. Tukasema that one you debit is an expense. For the management expense, we have 780 and the other one is 696. Then we have the legal cost. They are specific. So we have for the marine and we have for the fire. So the legal cost, nazileta hapa. For the legal cost, we have 216 and 156. Also, we had the bad debt. You can see here we have the bad debt written off. We have both for marine and for the fire. So for the bad debt, we had 204 and we had 144. Then let's go to additional information number one. Number one, you are told that an earned premium reserve for an expired risk is to be maintained at 100% and 50% of the premium for marine insurance and fire insurance respectively. So now for the unearned reserve, we maintain 100% and 50% of the premiums. So what does that mean? So that means for the reserves balance carried down, we are told that we maintain 100% for the marine and fire 50%. So unakuja hapa kwa net premium. You take for the marine, you see it was 66, you maintain 100%. So here you have 6,600. But for fire, 4560, we are supposed to maintain 50%. So you take a half or 50% of 4560, of which you'll get, that's 2280. 2280. Let's go to note number 2. Note number 2. Number 2, commission on both insurance ceded and reinsurance accepted is at the rate of 5% of the premium. So it's 5% for both ceded and accepted. You take the 5% of the premium. So for commission ceded here, you take 5%. But when I was giving you the definition, tulisema for commission ceded, is the income determined as a proportion of reinsurance premium paid. Kwa hivyo utachukua 5% of the reinsurance premium paid. And we had here, reinsurance premium paid. This was 960 and the other one was 600. For the commission accepted, it's still 5%, but we say that commission accepted, it's an expense determined as a proportion of reinsurance premium received. Kwa hivyo utachukua 5% of the reinsurance premium received. We had 1440 and 960. 1440 and 960. So 5% of 1440, you'll get 72. And 5% of 960, you'll get 48. Then here, 5% of 960, that one still get 48. And 5% of 600, that one you get 30. Then you can close your account. I think this side is more. So and you are adding that. So this one you get 7590, 7590. That means they operated at a profit. A profit of 2178. Then for the marine side, that one is 12408. 12408. Also, they operated at a profit of 1248. Now, what you get here as a profit, you take it to the income statement. Good. That was part number 1 of the question. We're supposed to present the revenue account. Yeah, the revenue account for both marine and insurance, marine insurance and fire insurance. Then number 2 is the statement of comprehensive income. And then lastly, prepare the statement of financial position. So let's present the income statement. So let's start with the heading. So we start with the revenue. Now for the revenue, we have both for marine and for the fire. For the marine, you bring what you have gotten here as the profit, 1248. And for fire, we had 2178. Then also from the, we also had investment income. Investment income. And kindly make sure you have a copy of your past paper. So we had investment income here, investment income of 336. 336. Then we deduct the expenses. Now for the expenses, you just bring the general expenses. We had the audit fee. Also, we have the director's fee. Then we also had depreciation of non-current assets. We had the audit fees paid was 288, director's fee 594, and the depreciation of non-current assets 1086. So this one is 288, 594, and 1086. Then you can get the profit before tax, which is 1794. Then you raise the tax expense. Note number what? Note number 4. Note number 4, you're told that the tax rate applicable is 30%. So you take 30% of 1794. So, and you'll get, it's 538.2. Now you get profit after tax, which will be 1255.8. Then they declared dividend. They declared dividend. Note number 3. Number 3, we are told that the director have proposed a dividend of 5% on the outstanding share capital as at that 1st March 2017. So take the 5% of the equity in the ordinary shares, and we have the ordinary share capital 3600. So dividend, you will take the 5% of 3600 and you'll get 180. So you get the retained earnings for the year, which is 1075.8. So that's the income statement. Let's now go to part C. Part C, they wanted the statement of financial position. So we start with the assets, particularly non-current assets. From the question, we are given the non-current assets. We had the freehold property. Also, we have the motor vehicle. Then we have machinery and equipment. Then we also have the furnitures. And then we have investment in shares. Yeah, that's what we have there. That's what we are given there. We have the freehold property, 50/40, motor vehicle, machinery and equipment. We have the furnitures. Also, we have the investment in shares. Investment in share. If you invest in share, that's an invest. That one is not part of equity. It's part of the assets. You are investing. It's an investment. An investment, it's an non-current asset. So freehold, it's an amount, or our shillings are in millions. Freehold property was an amount of 50/40. Motor vehicle was 4,200. Machinery was 1,800. Furnitures, we had 1,560. And the other one, we had 1,680. Then we go to the current assets. For the current assets, we have bank and cash. Also, we had the account receivables. Also, we have the premiums receivables. And lastly, we have the commission ceded. Now, for the bank and cash balance, yeah, we have the bank and cash in hand, so it's 132. So this is 132. Then we have account receivable and account payable here. Account receivable, it's an amount of 876. 876. Tuachane na hizo kwanza. Let's go to the equity and liabilities. For the equity and liability, we had the ordinary share capital. Also, I have seen we have the share premium. Then we have the retained earnings. Then you also bring the unearned premium reserve. We say that reserve, they are part of the equity. So we have an earned premium. An earned premium reserve. Then we go to the liabilities. Now, to the liability, we are not given the non-current liability. So first of all, let's fill for that. So we had ordinary share capital of that 600. We also have the share premium of 1,200. Retained profit, it's 540. So for the ordinary share capital, we have that 600. Share premium is 1,200. Now for the retained earnings, from the trial balance, we are given 540. Then you are supposed to add the profit for the year, retained earnings for the year, which is 1075.8. And the total, you'll get an amount of 1615.8. We'll come to the unearned premium reserve. Now for the liabilities, we are given the account payables. And the account payable given there was an amount of 396 of the trade payable. Then you bring the claims payable. Also, we have the commission accepted. Also, we have the current tax. And also, we have proposed a dividend. We have not yet paid. We had the proposed dividend. Now, for the proposed dividend, the 5% of that 600, which is 180, that one was proposed. So if it was proposed, that means we have not yet paid. So it becomes liability. So we have 180. Current tax, we provided a provision of 30%. That means we provided, but we never paid for it. So the tax 30% is 538.2. 538.2. Now, up to that point, you can now present like that. Now, twende kwa premium receivable. Now, for the premium receivable, we have the premium outstanding at the end of the year. So that's something we are supposed to receive, but we have not yet received. So it becomes part of current assets. Let's go to note number what? Note number 5. Premium outstanding as at that first March 2017 amounted to 1,800 million and 840 million for marine and fire insurance. So for the premium receivable, you add the two, 1,800 plus 840. You get 2640. Then we had another income we determined. Remember, we said that commission ceded, it's an income, but we have not yet received, but we provided at 5%. So it will take 48 plus 30. 48 plus 30, you get 78. You get the total assets. For the liability, or let's go to the liability. We had the claims payable. We say that claims is an expense. At the end, we have an expense we are supposed to pay, but we have not yet paid. So that one becomes part of liability. Let's go to note number 6. You're given that information, note number 6. Claims intimated and outstanding as at that first March 2017 amounted to 900 for marine insurance and 576 million for fire insurance. For those claims outstanding, they becomes part of current liability. So we have 900 plus 576, and that one will get 1476. Then we have the commission accepted. We say that commission accepted is an expense. Whatever the expense we have not paid, because we provided at 5%. So you'll take 72 plus 48. But you'll get 120. And lastly, we have an earned premium reserve. Now for the unearned premium reserve, you bring the balance carried down from the revenue account. I already prepared the revenue account, and we had the reserves balance carried down. 6,600, then you add 2,280. So you'll get here, it's 6,600 plus 2,280. You get 8880. That's how we present the balance sheet. And that's the end of that question. So we can look at another illustration. So let's look at December 2014, question 4. December 2014, question 4. Just hoping we are there. So part A of the question is asking about differentiate between the term commission on reinsurance ceded and commission on reinsurance accepted. I already given you the difference between the two. Now let's go to part B of the question. Part B, you are told that the following trial balance was extracted from the book of the Apex Insurance Limited, which specializes in general insurance as at that 1st October 2014. We have the direct premium received, reinsurance premium received, reinsurance premium paid, account receivable, bank balance, and cash in hand, and earned premium as at 1st November 2013. Then we have the claims outstanding on as at 1st November 2013, claims paid, legal expenses, survey expenses, bad debt written off, investment in shares, freehold property, motor vehicles, machinery and equipment, furnitures, audit fees, directors' fees, depreciation on current assets, management expense. Then we have the account payable, investment income, ordinary share capital, share premium, retained profit, premiums outstanding as at 1st November 2013. Additional information. Number 1. Premium outstanding as at that 1st October 2014 amounted to 6 million and 16.8 million for marine and fire insurance respectively. Now those are the premium balance carried down. Number 2, claims intimated and outstanding as at that 1st October 2014 amounted to 18 million for marine insurance and 11.52 for fire insurance. Number 3, an earned premium reserve for an expired risk is to be maintained at 100% and 50% of the premium for marine and fire insurance respectively. Number 4, commission on both the reinsurance ceded and reinsurance accepted is at the rate of 5% of the premiums. Number 5, the directors have proposed a dividend of 5% of the outstanding share capital as at that 1st October 2014. The tax rate applicable is 30%. Required, the revenue account for both marine and fire insurance for the year ended that 1st October 2014. Number 2, the statement of comprehensive income and the statement of financial position. So we start with the revenue account. So the format does not change. So the format is the same. So we start with the premium received. You had already been given the premium received there. From the question, the direct premium received. Can you see that? Direct premium received, you are given that. Then we have reinsurance premium received, we have that. Then reinsurance premium paid, we are given that. So it will be, for the premium received, it was 108,000. The other one is 84. Then we are given the reinsurance premium received. Reinsurance premium received, 28,800. The other one is 19,200. Then we have reinsurance premium paid. If we pay that one, it becomes an outflow. So it will be 19,200 unatoa hiyo and 12,000. You minus that. Then we had already been given the premium balance carried down. Additional information number 1, where we had 36 million and 16.8 million. Then from the trial balance, we also given the premium as at 1st April 1st November 2013. That's at the beginning of the year. So we say that we add premium balance carried down, but we raise premium balance brought down. And for brought down, we had 21,600. The other one we had 16,800. So we can get the net premium. For the net premium, this one you get 132,000. The other one you get 91,200. Then on the other side, we had the claims paid. Yeah, you can see we have the claims paid. Then we have the claims outstanding as at 1st November 2013. That's the balance brought down. And then we have other expenses such as legal expenses, survey expenses relating to claims, marine, bad debt written off. Those are some of the expenses. So claims paid, it was 59 to 80. The other one was 43,200,000. Then we have the claims balance carried down. That was note number 2. It was 18,011,520. Then we have the claims as at 1st November. That's opening balance, 19,200, and the other one is 12,960. Then for the claims expenses, we had the survey expenses. I've shown you that. You see, we are given here. Where is it? Yeah. Survey expenses relating to claims, marine. So that's part of claims expenses. So we have the claim expenses, which is survey expenses, which was an amount of 76,80. Now we can get our net claims. For the net claims, we'll have 65,760, and the other one was 41,760. Then we bring other expenses. We had management expenses there, which was 15,600. The other one was 13,920. We also had the bad debt, 40,80. The other one is 28,80. We also have the legal expenses, 43,20. The other one is 31,20. Then we have about the unearned premium reserve balance brought down. We have it here. We have the premium outstanding as at 1st November. Sorry, not that one. That's the premium balance brought down. Yeah, we have the unearned premium here. Unearned premium as at 1st November 2013. We had that. So that one forms part of unearned reserve balance brought down, of which we have an amount of 11,52. The other one, it's 60 million. Let's go to note number what? Note number 5. Note number 5. Note number 5, you are told that. Sorry, note number 4. Commission on both reinsurance ceded and reinsurance accepted is at the rate of 5% of the premium. So, to get the commission ceded, we are told is the rate of 5% of the premium. Commission ceded, we say that we get it as a proportion of reinsurance premium paid. And we have the insurance premium paid here, 19,200, and the other one is 12,000. So here we get the 960, and here you get 600. For the commission accepted, you do the same. It's the 5%, but as a proportion of reinsurance premium received. And here you have the insurance premium received, where we have 28,800. And here we have 19,200. You take the 5% of that. So this one you get 1440, and this one you have 960. In industry, Note number 3. Note number 3. An earned premium reserve for an expired risk is to be maintained at 100% and 50% of the premiums for marine and fire insurance, respectively. So, for the reserves balance carried down or an earned premium balance carried down, we were told that you maintain 100% for the marine insurance. So you come to the net premium for the marine one, that's 2,000. You maintain 100%. So this one will be one, that's 2,000. And for fire, you maintain 50%. So you'll take net premium is 91,200. You multiply by 50%. You'll get 45,600. Then you balance. You find that the credit side is more than the debit side. And here you get a profit. So they operated on a profit of 24,960. And here we have 43,560. So now let's go to part 2. Part 2 of the question, you are supposed to present the income statement. The income statement. So the name of the company is Apex Insurance Limited. Presenting the statement of comprehensive income. For the year ended. The year was ending on that 1st October 2014. The income is the same with the previous question we had done. You start with the revenue. And for the revenue, you have for the marine and you have for the fire. For the marine, you just bring the profit you have gotten here, the 24,960. And for fire, we have 43,560. Then you bring the investment income. Yeah, from the trial balance, you are also given the investment income, which was an amount of 67,20. Now we look at the expenses. I've seen the audit fees. Also, we have the director's fees. And we have depreciation on an current asset. Yeah, we have the audit fee here. We have the director's fee, and we have depreciation on an current asset. So you take those expenses there. For the audit fees, it's an amount of 57,60. The other one is 11,80, and then we have 21,720. Then you can get the profit before tax. The profit before tax, you get 35,880. Then you raise the tax. You are told that the applicable tax rate is 30%. So you just take the 30% of the profit before tax, that 5,880. You'll get 10,764, so that you can get the profit after tax of 25,116. Then the directors proposed the payment of dividend. We have the proposed dividend of 5%. That's note number what? Note number 5. Number 5, you're told that the directors have proposed a dividend of 5% on the outstanding share capital as at that 1st October 2014. So just take the 5%. Take 5% of the ordinary share capital, which was 72,000. Yeah, 5% of 72,000, and you'll get that 600. Now you can get the retained earnings for the year, which will be 21,516. So that's the income statement. Now let's present the balance sheet. So we start with the non-current assets. So we have the freehold property. Also, we have the motor vehicles. We have machinery and equipment. Then we also have the furnitures, and we have investment in shares. Here we had that. Then we go to the current assets. We had bank and cash in hand, an amount of 2640. Also, we have the account receivable and account payable. So you bring the account receivables. Another part of current asset, we said you need to bring the premium receivable or the premium balance carried down. So we have the premiums balance carried down. So that's part of premium receivable. And then we also bring the commission seeded. We said it's an income which is not yet received. Go to equity and liabilities. Now for the account receivable from the trial balance, you have it here. Account receivable 17,520. $17,520. For the premium balance carried down, note number one. Number one, premium outstanding as at that 1st October 2014 amounted to 36 million and 16.8 million for marine and fire respectively. So those premium outstanding, they form part of current assets. So you just add the two. So you add the 36 million and 16.8. You get 52,800. For the commission seeded, here from the revenue account, we had the commission seeded 960 and 600. You add the two, and you get 1560. Let's go to the equity and liability. We had the ordinary share capital. Also, we have the share premium. We had the retained earnings. Also, you need to factor in the unearned premium reserve at the end of the year. So you bring the unearned reserves. Now, for the ordinary share capital from the trial balance, you are given at 72 million. Share premium, you are given 24. Retained earning is 10,800, but that's the balance brought down. Then you add the retained earnings for the year, the one we gotten from the income statement, of which we had 21,516. 21,516 to get a retained earning of 177,600. For the unearned reserve, from the you come from the revenue account here. We had the reserves balance carried down. The balance carried down is what you take to the balance sheet. So you take that that 2 million, you add 45,600. You get 177. Sorry. So it's 177,600. For the retained earning, if you add the two, you are getting that 2,316. Then we can go to the liabilities. The liabilities, we have the trade payables. The trade payable was 7920. Also, you bring the claims payable. Now, for the claims, you bring the claims balance carried down at the end of the year, of which we had here. You see, we had claims balance carried down, 18,011,520. So it's 18. You add 11,520. You have 29,520. Also, you have the commission accepted. Commission accepted. Now, for the commission accepted, from the revenue account, we had the two. The commission accepted at 5%. We have the 1440 and we have 960. You add the two. Now, that commission accepted, we say that's an expense, which is not yet paid. We will pay. So you add the two, 1440 plus 960, and you get accepted. The total is 2,400. Then we have the current tax. Hatujalipa tax. At a dividend, we have just proposed dividend payable. So current tax, just take this one, the 30% of that, which was 10,764. 10,764. And then dividend payable here, it's 36. The dividend is 36. Good. So that's how we present the statement of financial position. So I want you to go and try this question as an assignment. November 2019, question 3B. Go and do this. Also, the one we have done, the second question we have done. So kindly you can go and try, read the question and then try to do by yourself. And then after you do by yourself, then you can mark for yourself. And this one I have given as a question, as an assignment. From the handout I'll send, I have provided the answer. So you do it and then you mark for yourself. So any burning question? So in case you have a question, kindly raise your hand. I want you to give like 2 minutes for you to ask live questions. So you don't type there, you just raise your hand. I unmute you and then you ask the question. Anyone with a question or a compliment, just raise your hand there. I can see there is no any question. Good. So have a good night. So that's the end of today's class.